Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Bond investments generally come with clearly defined time frame. However, not many understand that one should be more focused on the residual maturity of a bond and not the tenure of the bond. But what exactly is residual maturity in bonds and what is the importance of fixed income investments? Let's understand all of this with Ankit Gupta, founder director, BondsIndia. Ankit, good evening and welcome to the show. Let's understand the maturity period in a bond. Typically, a lot of people don't like this particular investment instrument because there are longer lock-in time frame, and they feel that they don't have enough liquidity in there. But then what if someone really wants to park in their money in something which has a longer duration lock-in period or a time frame and wants to get the maximum out of it?
So, Kavita, good evening. So, when you talk of maximum out of a bond investment, there are three things which needs to be analyzed. Bonds are available at all durations, right from a 3-month period to a 35-year period. So, depending upon what is the kind of requirement that you have in terms of investment horizon. So, the residual period of a bond may range between 3 months to 35 years. For giving an example, there's a Government of India security which is available at a 35-year period. So if you are looking to really lock your funds for a very, very long time, you can go for that investment. There are corporate bonds which are available for an average time frame of 3 years to 15 years. So when you talk of time horizon or a residual horizon, bonds are obviously available for whatever duration you are looking from, right from 3 months to 35 years.
What is the difference between the complete maturity period and a residual maturity period? Are these two different things, Ankit?
Yes, when you talk of a complete maturity period, the complete maturity period starts right from the allotment of the bond till the maturity of the bond. When we talk of a residual maturity period, it is basically talking about how much of a time left gap is left. So let's take of an example, which is any kind of an asset which has a which has a maturity of 3 years. And if you're buying that asset after a year and a half, then the residual maturity stays at 1.5 years. So in terms of bond, a bond which has come out with an issue somewhere around is saying 2020 with a 5-year maturity. So the total maturity period of a bond is 5 years. But sitting today in 2023, half the year is gone. So the residual maturity of that bond is only 1.5 years left now.
All right. So what is more beneficial and how can you earn maximum out of these two type of maturity periods? How should you strategize it?
So when you talk of maturity period and when you talk of a residual maturity period, a maturity period is something which doesn't matter to you as an investor because it includes the past and it includes the future. So for example, the bond which was issued in 2020, and if you are buying it today, the 3.5 years which is gone doesn't matter to you. So what matters to you is what is left in future and what are you going to earn in the future. So when you talk of a residual maturity period, that is what is important for you. And when you are buying an investment or you're looking for an investment in fixed income, what you need to look into is the time horizon that you're looking to park your funds for. So for example, if you say that you want to park your funds for 3 years, then you should look for a bond which has a residual maturity of period of somewhere around 3 years in and around time. So the best way to invest into bonds is obviously when you're looking into a residual maturity period, that is what the time frame should be to invest into these bonds.
And this will not apply to a longer term fixed income instruments like a PPF or a Sukanya Samriddhi? Ankit?
So when you talk of PPF or a Sukanya Samriddhi investments, they definitely offer a much higher return and a much good return as compared to what some bonds might be giving in as well. But then again, the only thing which we need to look into is a PPF comes with a 15-year lock-in and a Sukanya Samriddhi comes with a 10-year lock-in, right? When you invest into bonds and when you have a shorter time duration, then these might not serve the investment horizon that you are looking at. So yes, they are very good investment horizons as compared to other papers on the similar duration. But however, having said that, when you talk of diversification into fixed income as well, there is a limit to investment into PPF and Sukanya Samriddhi. For example, in a year, you can't invest more than a year, 1.5 lakh rupees in PPF and 1.5 lakh rupees in Sukanya Samriddhi. But beyond that, if you want to invest into, then fixed income is something which will come into play, and that is where you will have to get the investments done.
What are the kind of bonds that you can recommend to our viewers, and they have an investment option right now?
So if you talk of bonds obviously have a lot of variety, right from a AAA. So I'm talking of rating because AAA is something which the investors might not understand. So bonds have a lot of nuances which we need to play into. So one of them is obviously rating. bonds rate between AAA till triple B category. So depending upon the kind of rating and the kind of tenure that you are looking at in terms of investing into bonds, you can expect a return of somewhere between 8% to 14% in various categories of bonds. So for example, if I'm looking at a very good, very safe name, practically risk-free on a AAA side with a PSU like a HUDCO or a REC or a PFC, the interest rate would range between 7.5% to 8%. If I go on a lower rated kind of a bond, which is like the second category on the AA bracket, the range would be 9.5%. And if I go on a next level, the range would be somewhere around 11.5%, 12%. So depending upon your risk perception, depending upon the kind of risk that you can take and the kind of tenure that you're looking at, you can easily earn between an average of 9.5% to 10% on any of the bonds that you invest into.
Looking at the interest rate trajectory right now, what's the duration that you would recommend for anyone to park in their money?
So if you are looking at a duration call, or if you are really looking at trading into bonds in terms of the duration or playing around with the expected fall in the interest rate, then definitely you should look at a horizon of somewhere between 3 to 5 years. That is a medium-term horizon. Why? Because if you see the yield chart or the yield of the GSEC, there's an inverted yield curve. The short-term yields are much higher as compared, are almost on the same rate as a 10-year paper, right? So when you're looking to invest into a medium-term bond and in the falling interest rate scenario, that is what we are perceiving in the next 1.5 years. The bonds in 5 to 6 year range would give you a decent return along with a bit of a capital gain going forward in a year and a half.
What are the taxation or what's the tax implication when you invest in bonds and in such kind of fixed income, longer term investment instruments?
So when you talk of taxation structure into bonds, there are two things which we need to analyze in bonds. One is obviously the regular interest income that we earn in. And the second is obviously if you are looking to sell the bonds in a way wherein the price of the bond has risen up or risen down, whichever way it is. So when there is an interest component involved, the interest is taxable at the same rates of the taxation structure of the SSE, which is 10%, 20%, 30%, depending upon which income tax slab you fall in. When we talk of a gain which is beyond a year, which is a price gain in terms of the price of the bond, then this is taxed the long-term capital gain, which is obviously taxed at 10% without indexation and 20% with indexation.
All right, so that was all about bonds and how can you make the most of it and look at residual maturity. Thank you so much, Ankit, for being on the show and helping
Thank you, Kavita.
We will slip into a short break, but then post that, let's get your portfolio queries answered by our financial planner. And also, if at all you're someone who is looking for some guidance, you can send us your questions on our WhatsApp number and email ID. See you after this break.